Welcome back. You're watching Stock Watch with me, Zinati Goma, and joining me to unpack your stock-related questions tonight are David Shapiro from Sasfin Securities and Grant Nadet from Benguela Global Fund Managers. Be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gents. Now, we've seen quite good movements on the markets, on the JSE and also on the Rand. Grant, just how good is the inflation print that we got today?
Well, it was better than expected. That's the first thing. And the second thing is it's the third month that it's moving down. So the downward trajectory has gone from 5.9 to 5.5 to 5.1. So that's very positive. I'm very encouraged by that. The other thing I really liked was we saw that food costs continue to come down. I mean, food inflation has been one of the stickiest points of the inflation print. And then energy costs also coming down for the year, only up 2.6%. So if you think about, your broad consumer base, the food and the energy, I know they exclude them from core, but surprisingly, but those are the most important for most of us. We feel them day to day. So I like those parts of the print. I think the core inflation seems to be holding steady in the smack bang in the middle of the range. So I think those are positive. I think it gives the Reserve Bank a bit of breathing room, and it limits the pressure on them to do anything. Maybe they're not going to cut, but there's certainly no pressure to raise rates at this point.
Yeah.
So overall, I'm encouraged.
Yeah. Grant talks about the food inflation that's been quite sticky. I'm sure we'll all be celebrating soon. Prices of rotisserie chicken at Woolies maybe going down. Talking about Woolies, we did see...
Don't hold your breath there. Don't hold when we talk about coming down, it came down from 9% to about 8.5%. So it's not down it's not down at 1 or 2. It's still high.
Still high.
Yeah.
But it wasn't.
I'm with Grant. There are two things I don't like. One is EBITDA, and the other is core inflation. Because believe me, we all fill our cars up, and every time there we kind of look at the amount and say, is that real?
Yeah.
Or did you put the person before me's petrol count on mine? Whatever it is. So it's very much part of what comes out of your pocket. So I still think headline is the most important figure, regardless.
Yeah. I mean, David, as we're talking about Woolies, we did see the share popping today, and it was quite interesting because yesterday we did see it under pressure after it released that trading statement. But seeming that TFG lifted up the retailers today, would this be a comfortable time for investors to go into the South African retailers?
Well, there's a lot of work to be done. When you go through the number, there's nothing extraordinary in there. They're still battling. And I just had some meetings this morning where I was asking the same question that you are, and also from the property side. And there's no real turnaround yet. I think we're looking at the low. We're coming off a low in all of these, and I think that's why markets are picking up. It's a good time if you're a trader and you want to pay the turnaround, but we've got to see a lot more to make this sustainable.
Yeah.
There are a lot of numbers that come out, 5.1% here, and like for like, and I can't get my head around all of them. I look for the trend, and I still think there are a lot of issues that this economy is facing. But look, the markets picking up, and global markets up. I don't know. We're recording this earlier for those who are going to be watching. So Wall Street is just open, and I mean there's a staggering gains as well. Netflix and even the European markets, ASML. So there's a lot happening on the global markets. I think that's going to help us pick up.
All right.
And China as well. They're trying hard.
Well.
Sorry, Grant, I'm talking a lot.
Talking about China, and sending the question through to Grant. There's a question on China. The viewer is talking about the 5.2% growth. That's not disastrous. And just basically asking, is the panel optimistic or skeptical on Chinese companies? And if you are skeptical, what could be some of the reasons for your lack of confidence? Grant, and of course, looking at the fact that on the JSE, we are exposed to Chinese tech.
Yeah, not only are we heavily exposed to Chinese tech, we're exposed to China through the commodity prices, which
Yeah.
are driven still by China, which is the largest consumer in the world of commodities. The problem we've had over the past year is those authorities have changed the way they stimulate their economy. They're trying to manage the economic growth, but not in the way they used to, where they would just pump in infrastructure programs and massive stimulus in a counter-cyclical manner. So, and then there's been a lot of intervention in the economy that's broken some confidence. Sort of in the tech sector, we've seen them intervening and sticking their nose in various places. But I think the imperative to support growth is gonna push them to sort of back off a little bit. We've already seen a bit of that. There's further stimulus coming in. I think, markets like certainty, and the reason China has gotten so cheap is there's certainty around the regulators has been very low. One day they say this, the next day they say that. So I think if you look at how much is priced in, there's a lot of negative news priced in. There's a huge margin of safety, but you need some level of confidence that you can trust the outlook, at least to some extent. And so I think it starts to look interesting here. I think the authorities are waking up. We saw another reserve ratio cut yesterday or this morning. We saw them come in with a number of stimulus measures over the past 6 months. They've retracted the recent gaming intervention they made, which caused that big sell-off in Tencent and Naspers. So they're walking that back. I think they're waking up to the pressures, and they're going to step back a little bit. They can't kill growth. And so I think the risk reward is gently moving into your favor at this point. But I wouldn't go boots and all into China at this stage. So it's a balancing act.
Yeah, David.
It's interesting, yeah. Yeah, Zanardi, what's interesting, and I'm with Grant in this respect, I even think we're going to see the bottoming of the commodity markets. But your choice is, okay, so do we go for China turnaround or do we stay with the winners, where we feel comfortable and so on? So I think if you're a little more, if you favor risk and you want to find a 10-bagger or a 5-bagger or whatever it is, you might find it there. I look at it from another point of view. I just want the consumer in China to come back, who's going to start buying LVMH again and all the luxury goods and so on.
Yeah.
But there could be a turnaround story. I actually looking at commodities and saying maybe we've seen, maybe we're seeing the bottom there. And I would rather go for like the diversifieds than say go for the particularly like go find a platinum stock or a coal stock or anything. So I think by putting a basket of diversifieds, you can play that. But I think the bottom line, if you're not picking it up, we're going to see good markets this year.
Yeah. Talking about the commodities players, there's a question here: Sasol versus Exxaro Resources. Just sticking with you, David. You're talking about going for the diversifieds. Would Exxaro be one of them, or maybe it's just too limited for you?
Yeah, I'm concerned about coal and iron ore. It's too much of it's a difficult play. That's why I'd rather, if you put a basket of South 32 and Glencore and Anglos and Billiton together, I think you're going to get an array around the globe, and you're going to get copper and nickel and all of those thrown in as well. So, I'm not that confident now that you've got to go for specifics, for iron ore or for coal and that. Yeah. But I prefer to play the commodity through those diversified.
Well, Grant, let's take it to another level. Sasol versus Exxaro. Which would you say is better and a better dividend stock to buy and keep buying for dividends? I actually did have an analyst yesterday talking about how, the dividend story for Sasol, he's not really too confident about it because also there's still the debt picture, and then there's also these operational challenges that they're going through, and then the ESG requirements and all of that. So what would you say for dividends, Sasol versus Exxaro?
Yeah, and that is a tough question. I don't think either of them are a great dividend banker. So I would rather buy a more diversified miner. Sasol has got all of the challenges you mentioned that are actually, a lot of it is out of their control, the things that are driving their earnings, and a lot of it is in their control, and with that they're doing a poor job of it. So all the operational impact that we're seeing and the things they can control, they're not managing those well. The external things, the chemical space is now more than 50% of their revenue, and that's a tough space. margins are squeezed. I think Sasol is going to always be a business that struggles. It's going to always look cheap unless there's a massive macro story that plays out and does it for them. They're not going to do it themselves. Exxaro, you're taking coal price risk. It's probably a cleaner play in a sense, not clean, no pun intended there, but it's a purer play in that, you know, coal is still very much in demand. There's still a need for it. We've seen that now. I think they've got a reasonable pipeline of assets and production, but they're also exposed to Transnet and they're exposed to the coal price, which is, you know, it's up and down. It's Eskom. They've got a lot of challenges. If I was investing for dividend, I wouldn't invest in either of these two. If I was picking one of these two, I would pick Exxaro simply because I think they've got fewer structural and operational challenges versus Sasol at this point in time.
Yeah. Let me stick with you, Grant, because you're talking about coal and Thungela. There's a question here on Thungela. This was sent yesterday. What is the reason for the 5% drop in the share? That was yesterday. Of course, it has recovered today. Grant?
So that was a broker downgrade. One of the big international brokers downgraded it, basically saying that it hasn't discounted enough for the fall in the coal price. You know, I think these are short-term. This is short-term thinking. You've got to have your long-term view on coal, on the global economy, what the outlook is, and then, you know, those kind of downgrades and upgrades create short-term noise. There are actually opportunities for the DIY investor that's, you know, got a longer-term time horizon. You know, I'd be wary of those short-term moves.
Yeah. David, would you be downgrading or upgrading Thungela for opportunity at this point?
I'm not a great fan of these kind of levels. I still think the prices are going to go nowhere. We had their, you know, the golden moment, or sorry, I don't know how you talk about a coal company. I mean, their best moments were a couple of years ago when the coal price went to, you know, the 300s or wherever after the war. And that's come down, and I can't see in this kind of environment coal prices really picking up. They'll do okay.
Yeah.
So how do companies make profits now? They've got to mine at these low levels or wherever the coal price is at these points. They've got to get their, you know, they've got to get production right, and they've got to get distribution right, and they make decent dividends, and they, you know, decent cash, and they pay it out.
Yeah.
But I wouldn't make a point of going for Thungela. Again, you know, you want coal, go for Glencore or go for any other miners as well.
Yeah.
You can get a whole array of them. But I'm not you know, it's a dirty industry.
Yeah. There is a question here on the Satrix NASDAQ 100 ETF. Your view on it as a buy for the next few years. The ETF outperforms our JSE market by far. Also, the S&P looks like it is heading for a bull market. David, Satrix NASDAQ 100 ETF.
My wife owns it, so...
Okay,
yeah.
Definitely.
I'm going to say something to you, seriously, Zanat.
Yeah.
You know, we tend to overlook this, but I mean, last year, I don't know what it gave last year. It could have been 40 in Rand.
Yeah.
It must have been in 40% or thereabouts, you know, and the S&P gave about 30%. I don't know the exact numbers, but we tend to overlook it. It's you know, we forget that you can actually get into the NASDAQ and into the S&P. And I still think, some of the results coming out now and what we're seeing, I still think that, you know, for the next few years, this AI story is bigger than we can grasp, regardless of where it's gone. So we don't have to fiddle around in Thungela and Exxaro's, you know, just buy the S&P and NASDAQ ETFs and that. And you don't have to sweat either.
Well, it's quite interesting, David, because I feel like this is polarizing to some extent, because last year, I think the same question or a similar question was posed by, not last year, last week. And the analysts, I think both of them, or one of them was like, not going to touch it at all because the valuations are quite lofty. Grant, where would you be?
So I'm with David in most respects. So I think you need to define, what is your timeline? What is your purpose? You know, if you're going to take a 5, 10, 15-year investment horizon, just buy it and close your eyes. Yes, it might be expensive now. The earnings growth will override the valuations in a couple of years if they, you know. So in terms of the cutting edge of growth and innovation and technology, playing out in the world, it's all captured, or most of it is captured in that index. And you need to have some exposure there. We don't have the ability to gain exposure to that in South Africa on this exchange. We have one tech stock, and that's Process, which is captive to China's Tencent, and a few other small techies. So there's a whole world out there that we can't get exposure to through the companies listed here. This ETF is a great underpin. You buy a handful of ETFs, you put them under your pillow, and then you play around if you want to trade in the Thungelas, if you think the cycle's turned, to David's point, you play around, but that's not your long-term, put it under your pillow and forget about it story. I wouldn't. So you just need to define what
outside. I just apologize. I'm across the road from the Wanderers, and obviously there's a game tonight. And everybody who comes here and parks feels the urge to go and hoot. So apologies. It's coming through.
No, it's okay. It's okay. We haven't heard it. Talking about things that you buy, put under your pillow and close your eyes. I don't think David did this with Nampak. There's a question on Nampak.
You close your eyes.
Complete opposite. David, I know that you've been very cautious on Nampak. You always mention, where it comes from. It's a case of once bitten, twice shy.
Yeah.
What would you say about Nampak at this point?
The more I think about it, the more this is a management issue. It's not a company issue. We always blame the company. It's not. It's the management that have taken it down. It's poor management decisions over a long time that have taken this really great company, and it was a superb business, down to where it is now. It's very difficult to forget, what they've done and to repair the damage. At the moment, I haven't seen any kind of short-term strategy that's going to change the direction of the company. Yeah. And sometimes I like to play around and look at these companies that have been beaten down and bounce up, where there's a good chance of a bounce. But I think structurally this has got a lot of issues, And you see companies, I mentioned like an EOH, where poor old Stephen, he tried and the damage is too embedded, to just suddenly change it. Tongaat's going to find the same kind of thing, although probably more of a chance there. But it's quite sad to see them, and that's where I put Nampak, in that kind of category. It's been managed down. It's not, it's management's fault that they are where they are.
Yeah, it's quite interesting that, David, you make a distinction between management and the actual company. And even last year there were questions, is Nampak too big to fail? Because, the business, it's a good business. Grant, what would you say? And would you maybe see opportunity in a turnaround there on Nampak anytime soon?
Personally, I prefer to avoid these kind of companies. The problem is there's a lot of them out there that have been beaten by bad management, over-indebtedness, and of course, tough environment. So unless you think the environment is going to improve, the economy is going to start growing, these guys, where's the turnaround going to come from other than sort of internal reshuffling of the balance sheet and the capital structure? And it can happen, but it's a much tougher road to recovery. As David said, they did that with EOH for 5 years, and they still can't drive earnings growth because there's no earnings to be captured out there. There's no growth in revenue. So the good companies are performing well in the tough environment. The bad companies are getting worse because it's so difficult. And I would stay away from these small caps that have been beaten. There's a lot of good quality companies that are cheap as well that I would rather buy than buying a poor quality company that's cheap, because your prospect of recovering your money and making money out of it is much better, with a better company. So that's where I would be. Have a punt, but have a very small punt. Again, think about how you want to sleep at night. So,
I've got to tell you, because I run this competition, and this is not an advert for it.
Not sponsored.
What's the Crystal Challenge, and why I'm bringing it up is that I always like to see where people put their money. It's okay. It's not a real competition, but you choose 5 stocks.
Yeah.
And you can almost guess where they are, pick and pay. Pick and
Oh,
pay
yes,
number
of
one.
course.
Sasol number two, those are the ones. And 40, I just been going
Yeah.
through them, there are 45 portfolios with those two in, or something. There might even be more of them
Okay.
than that. So it just shows you that all I'm trying to do is illustrate the mindset of punters. They always believe, this is where I'm going to make my money, turnaround, And the ones that last year, it was Purple and Renogen, out, gone, got burnt on that one last year. I don't see anybody punting them this year.
Well, I have another one for you, ArcelorMittal, because Grant was talking about a bad environment, and ArcelorMittal is just another example of how you can't outrun a bad macro economy. They've even tried, internal strategies that just have not worked out. David, ArcelorMittal at this point?
Same thing, it's its environment. There is no economy here. There's no spend. There's no infrastructural spend. There's no spend on developing the economy. Whatever money we're earning here, tax money, is either going on interest or paying social grants. So there's nothing going into growing this economy. And against that, it's very difficult for them to prosper. We tend to ignore that. This is high capex stuff.
Yeah.
And so it's against that. It's very hard to see a company like this turning around.
Yeah. Grant, would you be sharing the same sentiment?
I would, and I'll just add that, remember, it's an energy intensive business. Energy is getting very expensive. It's going up at 16-17% a year, way more than inflation. And the market here is very small. So you've got to be exporting and competing with global markets that are operating at a much larger scale and producers. So I don't see how this business makes money. I really don't.
Let's go into businesses that you feel very confident about, that they are making money. Your stock picks for today. David, what will it be?
For me, it's my favorite company. And it's a tech company that, in fact, management says very few people know anything about, and that's ASML. They came out today with their numbers, and what's interesting is not what's happening now; it's what they see in 2025. The huge growth in the business. They were up 30% in 2023. I don't know where they're going 2024. Why I bring it up is that they make the machines that the chip makers need to make chips. Not fish and chips, but semiconductors. And when you see their outlook and you see where the growth is, it gives you an underpin or understanding of where tech is going. This driven by AI and driven by various aspects of it. So it's a very good portent of what lies ahead. The shares, the last time I looked in Europe, were up about 6% or thereabouts. I still think it's a business that you can keep buying.
All right. On your side, Grant, what will it be?
Just a quick one. I also like ASML. It's actually a stock we hold in the global portfolio. So, let's agree with David on that. So my pick is actually the other side of the spectrum. I've gone for, in some respects, purely on a valuation basis, I've gone for Prosus on the basis that you're getting a 30+% discount to Tencent. So Tencent in itself is cheap. Prosus is trading on about 10 times forward earnings, and I think you're seeing the sort of the trough end. Prosus themselves are focusing on profitability. Their businesses are starting to turn around at the core, moving toward profitability. So that's an internal tailwind. And of course, if you look at Tencent, I think the Chinese authorities are walking back some of those restrictive measures, trying to drive that tech ecosystem and stimulate growth. I think they're going to continue to capture some margin that they've been doing over the past year and a half. I think we're going to see, as the global economy moves into the rate cutting cycle, it's going to favor the consumer spend. A lot of their money comes from gaming. So I think there's a few tailwinds coming their way, not least of which is a massive discount to other global tech. So most global tech companies, if you look at the NASDAQ, and that are trading 20 to 30 times earnings. These guys are trading 10, 11 times earnings. It's a good price. It's a good entry point. There's a lot of margin of safety. So that's my pick.
Yeah. Grant, just sticking with you, 20 seconds, because I feel like this may be time sensitive. I'm gonna be kicked out of the studio. Rand Merchant Holdings, is it a good buy? Of course, the ex-dividend date is today. The share price crashed. They always pay a special dividend. Would you be going for it, for dividends?
So the dividend's been paid. There's only 38 cents left in the share. The 25-cent drop was the ex-dividend move.
Yeah.
So the share didn't crash. There's a small property portfolio left that they're going to liquidate and sell eventually. I don't think you're getting a huge opportunity there. It's just a winding down business. So
Yeah.
I think if you want to play property, buy a property company that's growing, that's doing something, that's got ambitions. So no, I wouldn't buy that. I'd buy another company.
All right. All right. I do have to leave it there. Thank you so much for your time and for your analysis today, gents. Really appreciate it. That is all for tonight's Stock Watch. Thanks to our guests, David Shapiro from Sasfin Securities and Grant Nadet from Benguela Global Fund Managers. Up next, The Close. Stay with us.